I think these are two markets that are cheap, so there is value in these markets. We need a bit of a catalyst to unlock this value, and talking to investors and fund managers, it looks like a big impediment for the market, for these markets at the moment, is really the geopolitical tensions, i.e. the relationships between the US and China. So we need to see an improvement on that. Also true is that China is reopening, it is quite clear. The number of people voyaging within the country is high, is actually above the level of 2021. So it's happening. We saw that they were not spending as much as they did in the past. So the numbers are improving, but remain on the underwhelming side. So there is an improvement. I guess expectations were for better numbers than that. So if we can get an improvement as well on this front, that will certainly help the markets. What we are seeing on par with the tourism ID is that consumer goods sector, for instance, is the beneficiary of any reopening. They basically has been always a beneficiary of reopenings in the world, not specifically in China, and we are seeing that happening here again. So that's a good sign. If you take a longer term view, there is value as well in the tech sector, which is, clearly benefiting from the artificial intelligence move that we are just beginning. I don't think that artificial intelligence will be limited to ChatGPT, just to illustrate the point. It's going to be a lot bigger than that in our lives in the future, in ways that are very difficult to understand today, but it's going to be coming. So what we've been seeing in the market so far is a lot of a wait and see approach from investors. And as much as we can understand the wait and see, and we share the wait and see if you want, positioning for equities in particular, because we do expect a US to be in a recession by the end of this year. But this actually creates opportunities elsewhere in the markets, and in particular in the fixed income side of the market. And within fixed income, the part that we like the most is really investment grade. Asian investment grades, US investment grades, these are low risk products in terms of volatility, in terms of risk of default. We do not want to be invested into high yield, because when we get into a recession, this is where the default rate picks up. And so you don't want to be in this market at that time. So we want to avoid the high yield, but we think there are very attractive options at the moment within the investment grade markets.